Hey, what's up, guys? It's Jonathan here, back with another live stream. So, we got a really big CPI report coming out tomorrow. And I wanted to just quickly go over some of what the market is expecting to happen, as well as talk about some predictions from some of the suits on Wall Street and talk about my predictions as well as some of the changes to CPI weights and how that will affect our the report that we see tomorrow. So let's first start off with what the market with the expected numbers. So currently we're expecting a month over month reading of about 0.5% and a month over month core reading of 0.4%. And if you remember from last month, the month over month reading from last month was actually negative 0.1%. So it's a significant increase that we're seeing. I believe the month over month core from last month was about 0.3%. So definitely this is going to be a much hotter report. Um, but it will still be interesting to see if with these high expectations, if we're still going to end up if we're going to end up beating these expectations or if we're going to end up under them. So let's move on to the change in CPI weights. So generally speaking, every year there's usually some kind of change to the CPI ratings, with the CPI weightings, I should say. So pretty much with the CPI report, they get a bunch of data from different sources, and they pretty much weigh out like how much the inflation in housing affects the typical American consumer. So every year they usually adjust it to some degree, and even in some cases even every month they adjust it as well. And they adjusted this most recent report they adjusted this most recent year to reflect the spending habits of Americans in 2021 and to adjust for some of the differences in spending that we did see from Americans. So there's some people out there that are very jaded. I see these people in my comment section all the time who are saying, "Oh, the government's just scamming us, blah 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 blah. This isn't. They're rigging the CPI numbers." And here's the truth: the CPI. Here's the truth: the consumers spend change the way they spend money based on what's going on in the economy. So, for example, if a pack of bacon costs 4.99 and out of nowhere and in a matter of like a month or two it starts costing like 10.99, then it's most likely that the consumer will change their spending habits. Because think about it, if you're somebody who's on a tight budget and you're used to something costing half of what it costs now, you're probably going to find some kind of alternative to change that with. Maybe instead of bacon, you start eating chicken sausage, or you start eating more eggs, or something like that. So, this whole ideal that the government is rigging CPI numbers, I don't really think is very valid. Um, but they did adjust it, and they adjusted it on the lines that basically for the things that didn't see too much inflation in 2022, those got adjusted down as smaller weightings of the CPI, whereas the things that that did suffer the most amount of inflation got adjusted up. So pretty much that's kind of ideal because the consumer is going to spend more money on housing if housing prices go up 20%. But if food prices only go up 10%, then they're going to spend less money on food, or they're going to have less inflation on food than they would housing. So with these adjustments, the relative importance in the CPI adjusted quite a bit for housing, which just makes sense given the kind of skyrocketing in rents we saw in 2022. And we did see some slight increases in recreation, which also makes sense because there's a lot of travel demand in 2022. And we saw a very slight increase in food and beverage costs, which, again, like I just talked about, um, food typically makes up about 10 to 12% of your typical American's budget. At least it did pre-pandemic. But like I said, with food, people tend to adjust their grocery purchases based on the cost of the good. So that does make a lot of sense. And then we actually saw some pretty significant decreases in transportation and medical care, which transportation decrease was mostly driven by the deflation that we've seen recently in new and used cars. And we'll actually talk about car prices later on in this stream. But we did also see a significant decrease in Medicare as well, which we have started to see that soften up recently too. So the CPI, according to JP Morgan, they came out with their own expectations on CPI, and I thought it would be good for us to review what they're expecting to see. So right now, they have an expectation of about zero point 0.5 for the month over month read in and about 6.4% on the year over year read, which is definitely in the right direction. It's definitely on the way down, at least on the year over year read in. On the month over month reading, it's a significant increase from what we saw last month. But for the year over year, we went from 7.1 in November all the way to 6.5 in December. So we aren't seeing that major leg down again. We're not expected to see that major leg down again in January. So we will have to so we'll probably see that when it comes to core, we are planning to see about JP Morgan is betting on about a 0.5% core read-in month over month, and then a 5.6% core read-in year over year, which is again in the right direction. It is going down from the 5.7 we got year over year last month, but it is a significant slowdown from the point from the 6 to the 5.7 we saw from November to December. So when it comes and this slowdown in disinflation, I should call it, is mostly being driven by energy costs, which we are planning to see that, which JP Morgan is planning to see a bump of about 2% on the month over month number for energy. Um, this is a significant change from what we saw in December, where we actually saw a negative 3.1% change in December. When it comes to owners equivalent rents, JP Morgan is expecting us to see about a 0.6% increase in owners equivalent rents, which is deflationary from what we saw in January, where we saw a 0.8% month over month increase. So that is heading in the right direction. Also, lodging away from home, we're going all the way from lodging away from home. We're going to JP Morgan expects that we're going to see a negative 0.8% month over month downturn on that, which is good to see because we did get actually a 1.1% uptick. And what we have been talking about recently is that we do want to start seeing disinflation in the service sector, and lodging away from home is definitely one of the forefronts of the service sector. So it would be good to see a negative read on that. Oops, hold on, give me a second. Is this better? Okay, I hope you guys can hear me. Gosh. Okay. I'm sorry about that. I had some mic issues there. Um, we as well as so when it comes to rent, we are starting to see rent prices also deflate as well. So um we are JP Morgan is expecting us to see about a zero point 0.7 month over month read on rent prices, which it would be a leg down from what we saw last month in December's reading at 0.8%. So that is also heading down in the right direction as well. So now we got to talk about automobiles, and this is where it gets a little funky. So with the new vehicles, we are starting to see with the new vehicles, JP Morgan does expect us to see a leg down in month over month inflation at a negative 0.1%, and would be a significant leg down from what we saw last month with the December reading at 0.6%. So that is kind of good news for inflation, that we are seeing the price of new vehicles start to slow down. But when it comes to used vehicles, it's a completely different story. So with used vehicles, we went from a negative. So we went from a negative zero point 0.2 reading in December's CPI report all the way down to a point, and we're expected in January to go up to a 0.5%. And this is mostly has to do with the uptick we have seen with used cars. There was some data that came out from Manheim where they actually did talk about that prices for used cars ticked up 2.5% in January. And given that used cars make up about 4.5% of the core weight in, for every 1% used cars go up, that's about a 0.05% increase in the inflation read in. So if we have a 2.5% increase, that means that we have an increase of about 15 basis points or 0.5%, which is not a good sign, because that's a sign that some of the good news that we got on goods inflation coming down is starting to undo itself, which is very scary. So that is something we do really want to watch out for, to see if we do get that high used car read-in. So JP Morgan does expect us to see an uptick in public transportation costs, going from a negative 0.5 read in December up to a positive 0.8% read in January, which isn't really the best, because generally speaking, it's usually lower income people that rely on public transportation. And we really don't want to see an uptick in that, especially if we do want to possibly avoid a recession. So that is something good to kind of for us to look at there. So let me see. Hi, Nora. How are you? Thank you for joining us. And thank you for that heads up. How are you? I'm doing good. Thanks for asking. And okay, so Green Glow, I have like these LED strips that you could buy on like Amazon, and and you could put them up against your wall, and it'll make like your wall glow. And they're relatively expensive. I think for two of them it was like $50, but I don't know, they're pretty nice, so I like them. Um, so let's move on and let's talk about some of the expectations we're seeing from the suits on Wall Street. So we have expectations from both Morgan Stanley and J.P. Morgan Trading Desk, and Morgan Stanley is forecasting a 0.4% month over month read-in on the CPI report. They expect that if we get a CPI report that's around 0.2 or lower, that we'll see a rally in tech and consumer discretionary stocks, as well as a rally in fixed incomes as well. So when I say fixed income, think like treasuries or bonds. And then for if we do get like a reading like zero point 0.6 or above, then they expect us to see a massive movement away from risk stocks and more inflows into consumer staples. So like a lot of the stocks that have done well in 2022, like oil, McDonald's, Walmart, those kind of stocks. Whereas the JPM JP Morgan's trading desk, they actually focus more on the year over year numbers, and they believe that there's about a 65% chance of a there's a 65% chance of us getting about a 6 to 6.3% month over month read-in, which is slightly lower than what their firm estimates of about 6.4%. And they expect that if this outcome was to happen, we'll probably see an S&P rally of about 1.5 to 2% tomorrow. So when it comes to my predictions, um, I I think that these expectations for CPI are very high, and this is somewhat rightfully so, given the fact that we have seen the uptick in used car prices. Energy prices have moved up as well, a lot more mildly than we saw in 2022, but we still are seeing some price action to the upside there. Um, but I think that these high expectations also give us the opportunity, also gives us a better opportunity to miss to the low side. So I strongly doubt we'll miss to upside, just given how bearish the predictions are. But if it does come in at estimates, I do think that we're going to get a mild green day, like maybe a 1% S&P day. Um, or if we do get but if we do get something maybe lower than zero point 0.4, then I think we will probably get a strong overall rally, especially in a lot of the like longer duration investments like tech stocks and unprofitable companies and the SaaS companies and things like that. Um, but what does all of this mean for the Fed? So the hot jobs report definitely helped the Fed make its case that they do need to go over 5%. But but unless if we get a read-in like under like zero point 0.2, zero point 0.3, we'll probably see the 50 basis point worth of hiking, which will push us to like the 5.25% terminal rate. But I do think if we do get anything like strong to upside, like zero point 0.5, zero point 0.6, then that'll definitely make the case for the Fed to go past the 50 basis points, which would be the hike that we would get in March and the hike that we'll get in May. And they may even go and extend the 25 basis point hikes past those two meetings. So we'll just have to see what we get in terms of this. This isn't really what the Fed is hanging their hat on for the next meeting. We still do have another CPI report next month before the Fed does meet. So we still have a lot of time left. Personally, I'm not going to trade this CPI report. I'm just going to sit back and watch. If we have a red day, then that'll be a perfect day for me to add. And if we have a green day, then awesome. I'll take it. So, let me see. Oh yeah, I did see that about Palantir. It ran like crazy. I didn't really look into it too much. Was it the gosh, let's see if we can pull it up here. I kind of want to see what happened with Palantir. I kind of, honestly, once upon a time ago, I did invest in Palantir, and I don't know, with the way the Fed is right now, I don't know if I really want to touch a company like Palantir, but it is, hmm. They missed on EPS, not by a lot. They missed, yeah, they didn't miss by much, but they did beat on revenue. So interesting. Yeah. For me, I'm just not touching the unprofitable stuff right now. So, but it is something definitely good to look at. Price. You think Amazon will close out this week? No. As much as I appreciate you asking, I cannot answer that question. I can't. I can't give financial advice, and I have no clue Amazon either. I've kind of stayed away from Amazon just because I think retail business is struggling to be profitable, and really without help of AWS, I Is this better? So yeah, with Amazon, that's another one I'm kind of staying away from as well. I worry with Amazon that they are just bleeding cash when it comes to their retail business, and it's just not something I want to be exposed to right now. The CPI report, it releases, it's 8:30 Eastern, or that would be Pacific. It's 5:30, 5:30 Pacific, 8:30 Eastern. 9:30. Where are you? Where's 9:30? I thought it was. Oh, you're gonna be on. Yeah, I got you. I got you. Okay. Yeah, so that's pretty much all I got for you guys. Thank you so much for watching. I'll see you in the next video. Peace.